Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
To wash or not to wash? That's the question. No, I'm not talking about smelly and got BO, need to take a shower. Don, do I stink? Does your portfolio stink? Does your money stink? Listen, we got a great question from the mailbag on wash sales and strategy. So we're going to go over that in detail today because wash sales, you've been told by Wall Street, are horrible, they're evil, they're bad. But are they? And we got another mailbag question regarding bonds, BLV specific, Vanguard and specifically. We're going to talk about that. And then we got IRA rollover. But first, and kudos to Don, because he's been getting multiple accolades lately, and he just did a deep dive. So he just did a segment on investing with IBD Wednesday evening. It's about 5 Central or Eastern, I think. And he did a deep dive on Revere assets, methodologies, and rules. And folks, when I say detail, for you stock nerds that like spreadsheets, he did a whole presentation, and he did a deep dive with Revere rules that is probably the most in-depth that I don't know, he's done quite a few, but that is very, very much in-depth. So if you really want to do a deep dive on Revere rules, go look that up on YouTube. And then Don is also a guest speaker at the annual upcoming Trader Lion Conference, and that's a whole weekend, and they got a huge speaker lineup. Of course, Don's one of the best in my opinion, but, and we may have some other exciting announcements coming up. We'll just have to see. But the whole point is Don is now being asked to speak at some very big events, and he's waiting with some of the big boys. He's standing on the shoulders of giants like Ropel and Fami and others. Anyway, with that, I want to go to the mailbag, and I'm going to set this up as a little teaser. Then we're going to talk about it. All right, 712. From BM. Dan, question for you both, meaning Don and I. As a new client, last year I had a hard lesson come tax season about wash sales. Will Revere keep me free and clear of wash sales? If I sell a position in my taxable account, will you wait over 30 days before buying? Thank you, sir, BM. Me. BM. Great question. I have copied the whole team so they can hear yet again, but you can never repeat it enough. Folks, this is going to be the gold nugget for the day. We got a couple, but that's a biggie. So I'm going to get to that in reverse order. First, I'm going to go to these other two mailbags because they're quite easy. And then we'll go from there. 714 AHS, he's also a client. Good afternoon. How are you and your family doing? Just want to let you know I transferred another $100K to my investment account you manage. I am still holding $150K, which I have invested in BLV. That's the bond fund. They're down 13% since I invested last September. Ooh, price is truth, no exceptions. But as part of a long-term bond strategy, ooch. You only look in hindsight and go, wow, that position acted right for 365 days that we earned long term. Every investment's got to earn its long term. You don't just assume it's going to be there because you may not have the gains. Anywho, I was down 13% since last December as part of a long-term strategy. I'm getting $575 of interest every month. Oh, and he said, correction, BLV's down 9.6, not 13. Me. Thank you for the heads up on the 100K. In my opinion, interest is irrelevant if you're down 9.6 or 13, whatever. That just means you're down less after the interest that you pay tax on if a taxable account. With us, you would be up. And if bonds came into favor, you'd be up for the year, over 10%. And if bonds came into favor and they were the strongest relative strength, you'd probably own bonds. but not going down. We're not going to ride it going down. He's wrote it going down. Price equals truth, no exceptions. If price isn't confirming your strategy, bond or otherwise, is it a good strategy? Here's his answer. Okay, I'm transferring BLV and the other investment to your account. Then you can decide whether to keep or move on. I said, perfect, sounds good. And folks, listen, this happens all the time. People put $300,000-$400,000 with this, test us, and then they go, oh my God, they're doing what they say they're doing. Oh, and they're doing much better than my pie charts are us over here with some random asset allocation and buying rotten sectors, rotten fruit for the portfolio, right? They end up bringing all the rest over, which has happened here, and it's happened quite a few times. Perfect. This happens all the time. New clients tries for a few weeks or months, and then they bring over all, or if not, the lion's share. So that was that one. Next one. 718 FC, another client. Dan, Dad died 12/24, Christmas Eve, 12/24/24. He had an IRA set up to do automatic RMDs in January. And in 2025, they did after his death. In a year, he never drew a breath. 6 months later, because it takes a while if you don't know what you're doing, it's like, Doctor. I could have had an RMD, but with all that was going on and no death certificate, I doubt I could have stopped it if I'd wanted to. He's saying it took 6 months to get the money transferred to his mom. So now he says, who pays the taxes on this RMD since January, since technically Dad was never alive in 2025? Me. Because your mom could have either done a regular IRA as a spouse, inheriting as a spouse, or a beneficiary or inherited IRA. Normally, spouses will step into the shoes of their deceased partner and just do their own IRA, and then it just goes on their own RMD schedule. However, if she did a beneficiary or inherited IRA, like non-spouses have to do, right? Then a regular IRA, she would have to take out any remaining RMDs he has for the next 10 years. So that next year in January, she would have had to do anyway if she took it as an inherited IRA. Okay. So now it would have to take out any remaining RMDs over the next 10 years and drain the entire IRA within 10 years, so not over your lifetime. In other words, you have to liquidate more quickly. That's the main reason you would do that if you needed the money. Otherwise, you normally do a regular IRA as a spouse. So the minimum amount every year taken would have been done anyway in a Benny IRA, no harm, no foul. In a regular IRA, the distribution could have been unnecessary. Now, her mom's old enough. She's taken her own. Now, this is a thought, too, I had after I answered him. Secondary heirs, okay? So when mom dies, who gets the money? Well, if she took it under the inherited IRA 10 years, she has to liquidate it within 10 years. So if she lives 10 years, there's nothing the kids inherit as an IRA. It's liquidated. It's gone. She had now maybe in her taxable account, but it's gone. So if leaving money to the kids is an issue, an IRA, a regular IRA as a spouse, is better. So this gold nugget is spouses normally should inherit their deceased spouse's IRA as a regular IRA, not an inherited IRA. The exception normally is if they're much younger, the spouse is much younger. That's normally the exception. All right. So those are the two mailbags. Now here is one of the topics du jour, so you understand this. So I'm going to read this again. 712 BM, Dan, Q4, question to both of you as a new client. Last year I had a hard less income tax season about wash sales. Will Revere keep me free and clear of wash sales? If you sell a position in a taxable account, will you wait over 30 days before buying again? Great question. I'm going to repeat it because you can never hear this enough. Folks, you never, ever, ever, ever lose a loss sale. I want you to repeat that to yourself. Mouth it while I say this again. You never, ever, ever lose a wash sale. Ever, ever. Okay? I said, but Wall Street wants you to believe they are very, very bad. They want you to have a bad attitude toward wash sales. Wash sales are almost all used up by the end of the year, at least the way we do strategy at Revere. The fractional remainder, if any, will be captured early that next year. Here's the key, folks. If you wait 30 days before buying again the same stock, you can significantly hurt your performance, because leading stocks that come into play at any particular time will move back and forth a few times before the real breakout occurs that you're looking for. Sometimes it just happens out of the gate. The first breakout's it. But a lot of times they'll break out, pull back, break out, pull back, break out, and then run. So you may get stopped out the first couple times before you get the real breakout, the first, second, or third, possibly even the fourth. And those are the best of the best stocks. That's what you want. The broker-dealers, a.k.a. the investment banks, see, they like to be called investment banks. They don't want to call brokers anymore because they sound like a used car salesman, which they are. Anyway, they put the wash sale totals on your year-end 1099 composite tax statement to scare the hell out of you. But they don't tell you that virtually all of those wash sales have been used up, and it just seems they simply leave the total over the entire year, used up or not, accumulated to scare you. But Schwab actually adds the total of the wash sale portion. So when you first buy a stock, you sell it for a loss, you have a stop on it, goes down 6% or whatever, you stop it. Then when you buy that same stock back a week later because it's setting up again, they will add that unused loss portion into your cost basis. So now the cost basis is already adjusted. It'll automatically be a less of a gain the second time. So the gain and loss will be netted, or loss and whatever it is will be netted. So you don't lose it. Okay. So you just simply cannot use a wash sale against another stock, but when you sell the same stock, they are netted. Therefore, the wash sale number, the accumulated wash sale number, is a meaningless number that does not help you at all. It is literally a meaningless number with no value to you. In fact, it's worse. It's purposely left there to scare you into thinking you have all these wash sales that you lost forever, or at least for a long time. It's nonsense. And if you listen to the sell side, it can only harm both your performance and higher risk with bigger drawdowns, because you're worried about selling, you're worried about trading. They want to make you think you need to buy and hold to get the long-term capital gains. If you buy and hold, now you got a coin toss whether those capital gains materialize or not. Look at sequence of returns. Go look it up. Google it. Sequence of returns. It's blown modern portfolio theory out of the water and completely debunked modern portfolio theory and the lie charts from Pie Charts or Us Advisor. Anyway, so you need to really ask yourself, what is the negative impact of wash sales? What's the negative? Nothing, but the timing of when you recognize the loss. At Revere, it's all about timing, and we are acutely aware of the wash sales. In fact, we embrace them as part of our risk management. You, if you want good risk management, need to embrace wash sales. Hedge funds have wash sales all the time. It's only retail investors that think wash sales are bad. Why is that? You're the fodder. You're the product. You're the cattle. He's the roper. He's the cowboy. He's delivering you from market to the Pie Charts or Us buy and hold. Anyway, price is truth, no exception. When it's time to buy, it's time to buy. When it's time to sell, it's time to sell. Anything else is noise created by Wall Street or other outside interest from the sell side. Okay, so I said this is absolutely a great topic. I'm going to do this on the mailbag because it must be addressed so that because the sell side absolutely wants you to hate wash sales, and they want you to keep buy and hope strategy so they can go play golf with you. Okay, at Revere, we're bringing you over from the dark side to the light. Okay, so I told him, we will cure you of that, and I am confident once you see our equity curve coupled with Revere's drawdown protection, you will welcome wash sales with open arms. The minor inconvenience wash sales incurs greatly outweighs the risk management. Great question. Keep them coming. He said, thanks, Dan, for the very detailed response and follow-up itself, in bold, on a Saturday. I must say your responsiveness and consistency is consistent, quite impressive, and very much appreciated. Have a great weekend, BM. BM, that is truly music to Revere's ears, so thank you. If it's still a question, feel free to call me. So I basically said, look, this Wall Street lies. It's basically Wall Street lies. They're telling you wash sales are bad. Folks, in my own personal account, I had tens and tens and tens of thousands of wash sales on my statement at the end of the year. You know how much were unused? I think it was like $500, $750, maybe $1,000. All of it was used. It didn't affect my taxes hardly at all. It was immaterial. But you think wash sales are bad. If you think wash sales are bad, you may be indoctrinated. You may be listening to Wall Street. So with that, Don, share how we embrace wash sales.
Well, Dan, it's let me give you an example of why you shouldn't be concerned about wash sales, and it's actually something that I should have done but didn't do. I'm showing a chart of Credo. We bought it on an earnings gap up here, and it just sold off for the next week, undercut the low of the gap day. That's one of our rules, and we got stopped out here.
And it could have gone down another 20%. You didn't know that at that time?
Could have.
Yep.
Right, it could have.
Yep.
Obviously, it rebounded very well. Wishing I would have bought it back, but hey, at least we get the wash sale out of the way here because it's been 30 days. But no, I should have absolutely bought this back. We were invested in other names at the time, and you can't own every single stock. We don't want to own too many things.
But had you owned that, you would have made a lot of money. So you shouldn't have listened to the Wall Street wash sale rule.
Now, if we had held this stock all the way through the end of the year, then you don't get to take in the 2025 tax year. Then you do lose that wash sale, but you do get to reclaim it when we finally exit this position. And I can count the number of stocks on one hand that we hold forever. And then there are none that we hold forever. We just happen to be holding NVIDIA for multiple years because we've got some big gains in that, and we are able to hedge them if the chart starts looking bad.
You hedged it a few different times, yeah.
Yeah, we did, right. But we're still holding. We've got like a 500% gain in NVIDIA from shares that were bought back in 2023. But yeah, with Credo, this absolutely should have been bought back, and I'm usually not concerned in any way, shape, or form about wash sales. Let's get to the markets now. So in our nightly videos, we've been talking about an 11-day consolidation that we've been in on the S&P 500. It looks better on the 30-minute chart. And it's basically this level to this level. And we broke out of it yesterday, and we pulled back and tested the 6290 level this morning, and it held, which is very good. So we're poking back above the 6300 level right now, but we're looking at a breakout from an 11-day consolidation right now. So we're changing our focus to whether or not we're going to hold this breakout. The markets are acting extremely resilient. Money flows are coming into crypto. We have positions in Grow and larger positions in Turbo. Turbo's had a fantastic last week and a half. But we just take things one step at a time. And in this case, the step was waiting for this breakout to occur or break down. And consolidations should resolve in the direction of the primary trend. Obviously, the primary trend is up. If it doesn't resolve in the primary trend, then you've got a changing character in the market, and we react accordingly. But right now, 6,200 level, extremely important. We're glad to see the 21-day moving average coming up to that level early next week. We want to keep our eyes above the 6290 to 6300 breakout level right now. We take it day by day. We did have a couple of names that we own that are getting extremely extended. And so let's see, I want to rate increase the size of this a little bit. We have an offensive sell rule, and we used it twice today for hood and for coin. And basically, that sell rule is if you get extended 3.5 to 4 times the average true range of the stock above the 21-day moving average. So you can see how this stock trended higher. It's the red line is the 21-day moving average. The line on the top is the +4 ATR. You can see it touched it a couple times a few weeks ago. We did some offensive selling then, reclaimed the shares when it pulled back. We hit that level again today. So we took some of that off. Actually, this is coin that hit the +4 ATR, but I can also show hood did the same thing. And we took some of that off this morning. You can see a couple of weeks back, this is where it hit the +4 ATR again. We reclaimed the shares when it pulled back, hit it again this morning and reversed off that level. So we're booking some offensive gains while these are in individual names that are definitely benefiting from being part of the crypto universe. Meanwhile, the S&P 500 is consolidating here. We've seen many former leaders pull back to the 10-week moving average or the 21-day moving average and are moving off of that level. We've seen a few 3 weeks tight that are starting to reaccelerate again. The mild concern that we have is the yellow caution light that we've been showing in the videos because of how historically extended we are above the 50-day moving average. Anytime you're over 5 to 6%, you want to tap the brakes a little bit as far as pouring money into the market. This has resolved somewhat with the shakeout 3 days ago. We took the short-term caution light off. We're still keeping this one on for the S&P 500, the NASDAQ 100. Let me show that as well. We're still over 5% above the 50-day moving average there as well. But it's a bull market until it's not. We just passed a very historically Christmas in July period that ended on 7/14. It's a 2-week period where stocks generally are very bullish. We're actually now in a weak period, the last 2 weeks in July and through August, but the market isn't acting weak. So those seasonal indicators are secondary indicators. The primary indicators are price and volume, and that's what we're going with. Selling some things that are extended to the upside, looking for low risk opportunities to enter other names. So that's any questions on the overall market before there's something very interesting I want to go into and warn.
No, I did, but I do have one quick question. Did you agree that was one of the most in-depth presentations you did on that IBD, investing with IBD on Wednesday?
Yeah, it was. And then I added a few more things in what's going to be 2 o'clock on Saturday, 2 o'clock Eastern time, my presentation for the Trader Line conference. I'll be online answering questions about it. And repeated a lot of that, added a few things, including a discussion of leveraged ETFs versus individual stock buys, which we're pretty have a strong feeling about. What shouldn't be bought versus buying a leveraged ETF. So
you're doing your presentation at 2 Eastern on Saturday, and then the Q&A will be following that about 3-ish.
It's already been recorded.
Okay.
They start playing it at 2. It's an hour and a half long, and then at the end of it, I can take questions.
So 3:30. So 3:30 is Eastern time.
Yeah, but people will be when it starts at 2. I'll be online at 2, and you can start asking questions during the presentation. So
got it.
2 o'clock and after is what it's scheduled for.
All right. I just want to make sure everybody got a chance to do that. And folks, if you watch that Trader Line and the IBD, investing with IBD on Wednesdays, you watch those two back to back on Don, you will have a really good understanding of our rules and how Revere works.
So the 2 things I want to share. Let's take a look at this ETF, IBIT. This is the spot Bitcoin ETF. We broke out of this range and made all-time highs earlier this week. This is the most popular spot Bitcoin ETF. There's another one out there that trades a lot of shares, and I have no idea why anybody would ever be involved with this, because it doesn't tell you in the title. It says ProShares Bitcoin ETF, but in the description, it says managed exposure to Bitcoin futures contracts. Does this look like a breakout to an all-time high if you would buy BITO? There are completely uneducated people out there. This trades 7.8 million shares a day. Look at this comparison chart between Bitcoin and IBIT. Here's BITO. It shows over the last year it's up 2%. Here's IBIT, up 85%.
Wow.
This is
Wow.
mind-boggling that you can have two ETFs by big issuing companies. IBIT is by iShares. BITO is by ProShares. The devil's in the details. BITO deals with Bitcoin futures. There's something called contango with futures, and the
Backwardation.
price is calculated. Yeah, contango and backwardation. The price of this is calculated using different percentages of futures contracts, and this is an absolute loser, a steaming pile of you know what. So that's the first thing I want to alert people to. The next thing is something that has happened in everybody's favorite conglomerate, Berkshire Hathaway. Back at the beginning of May, they held their annual, not their annual, they had their quarterly meeting. And actually, it may have been the annual meeting. I'm not sure. But Buffett announced he's stepping down as CEO. He's going to stay on as chairman, and the primary investment decisions are going to be made by his successor, whose name is Greg Abel. Look at how terrible this chart has been since he announced that. The relative strength line is going down toward 5 o'clock. And not only that, the chart itself looks bad. The relative strength line makes it look worse. Let's compare. Let's go with April 30th, and let's compare this to the S&P 500, because a lot of people always quote Berkshire Hathaway versus the S&P 500 and want you to see how it's doing. S&P 500 up 13.6% versus Berkshire up 7.5%. That's over the past year. Let's see how it's happening just since they made this announcement. So I'm setting it to 4/30/2025. Berkshire down 11%. The S&P 500 up 13%.
Wow.
We have a client that we spoke to earlier this week about working our way out of some Berkshire shares, booking it and reallocating this. This is a massive underperformance. I don't know if it's historically massive over. It's been a short period of time, but it's alarming. And this tells me there are a lot of people that just banked on Warren Buffett as being equivalent to BRKB. And if he's being removed from the day-to-day operations and not being the primary investment decision maker anymore, the S&P 500 is crushing this, and the relative strength line is reinforcing that. So major red alert if you own Berkshire Hathaway. And don't argue with me.
By the way, mutual funds have that often too. They've got a rock star fund manager, and then they'll leave, right? Like the Janus 20. The Janus 20 became real famous because I think I can't remember the guy's name, but he became that Janus 20. He was a stock picker and he was good. He moved and opened up his own mutual fund family, and then the Janus 20 fell apart. So these funds, the same thing. That's why our strategy, price is truth, exposes this, and as soon as it starts going down, it's going to get sold. It doesn't matter the reason.
100%.
Yep.
And this is the type of, this is what we do for our clients. This is the stuff we discuss on our videos every night, and this is how we manage portfolios. You can't assume something is always going to go up. So that's a review of the market, a comparison to two Bitcoin ETFs that are going in complete opposite directions, and the same thing with Berkshire Hathaway over the last two. And that's really kind of alarming to me. That massive underperformance while the market is headed toward new highs, and the stocks that they own, they're big in Apple. The stocks that they own aren't underperforming like this. It's just Berkshire Hathaway that's being distributed. So the Buffett pump that you traditionally got out of that ticker is going the opposite direction. All right, that's everything for me. Let's turn it over to, we got two presentations today. Todd is going to talk about mutual fund buys and how that can be used to keep an eye on different stocks. And something very key he's going to talk about is how a stock that was a major buy was supported this week. I think it's a great topic. It was being supported while it was being sold off because it was one of the major new buys of a bunch of mutual funds, and the stock had a very nice rebound slingshot back to the upside after a hard sell-off. So take it away, Todd.
Okay. And at the end of my presentation, I just want to make a quick comment on wash sales. So remind me, that may help the audience. So every month at the beginning of the month, the IBD posts the top mutual fund new buys for the previous month. And this is in millions. And what I've done here is summarize the top 20 buys in terms of the size. And I found it's a very nice tool to use to help find potential new leaders. Now, again, a lot of these names are going to be names that have been on here month after month, like in NVIDIA. NVIDIA this past month had a $24 billion of new buys, which was massive. Avgo, 14 billion, and goes down the line. So most of these are close to 2 billion that I stuck with. And again, you can see some of the names on here reappeared quite a bit. Robinhood, which has been, again, still almost 2 billion in new buys. And a lot of these names now are extended. But going back to the previous months, these names were on there and they would have been part of your watch list. Now, I'm going to talk about three specific names. And since Don mentioned it, let's start with VRT. And note here, VRT had a $5.4 billion buy by mutual funds last month. And that's pretty sizable for a stock like VRT. And he's marked on this chart the day where Amazon came out with a new cooling system. The stock tanked and was down all the way to the 50-day moving average and completely reversed that day and closed at the 21-day moving average. So if you had watched this, and this is something that I had known, and I present this every month on the weekend review, I know that Veritiv was a huge buy by new funds. And you can see this stock was heavily supported right off the 50-day moving average. So if you were not in Veritiv, or if you were in Veritiv and you had a big gain on it, maybe you were given the 50-day moving average your stop, you quickly got support here because you're in a stock that had heavy institutional sponsorship. And I also wanted to talk about another name that showed up on the list that has been a little bit of a laggard, but that's Shopify. Shopify had almost 2 billion in new buys, and you can see here it's been pretty tight in the buy zone of this cup with handle base. But yesterday it finally broke through. And this was a name that, again, looked like a laggard. And had you been had you had this on your watch list, it could have been a name you could have bought through this tight area, and it followed through nicely. So, and again, these mutual funds don't just buy 1 month and then they're done. These new buys, they can go on for several months because these companies may be allocating a lot of money to these stocks. And finally, we're going to talk about ANET. Now, this has been a little bit of a laggard, but it is a large cap networking stock. And ANET had 1.77 billion of new buys. And you can see it, relative strength has been going up. It reclaimed the 200-day moving average. And now you have a golden cross that's going to occur next week. So it is starting to improve. And it showed some nice new institutional sponsorship. So I just wanted to show an additional tool that you should have on your monthly review. And again, that comes out after the first of the month. And Don, did you want to add anything before I talked about the wash sales quick?
No, really good stuff, and it goes to it points out a lot of the rules that we use in house here, as far as support and resistance, identifying new ideas, and ANET really is one that we hadn't talked about for a while, but good to see that on the list as as the relative strength reasserts itself. And you wanted to talk about wash sales? You had a wash sale point?
I wanted to say that for our clients that are at multiple firms potentially, there are firms that report wash sales differently. Before I came to Revere, I was at National Financial, a firm that cleared through National Financial.
Yeah, Fidelity.
And they're part of Fidelity. And I don't know if Fidelity's retail side does the same thing, but in their 1099s, you will have this massive loss potentially in a stock. And then you'll have wash sales disallowed. And they don't net that out for you. You've got to actually take the wash sales and add them back into that loss to reduce that loss.
Wow. So if you got wash sales, Fidelity Investments is a nightmare. Wow.
It is.
Wow.
And all the other firms I've seen net it out in the final column.
Yeah, Schwab does it. Yeah.
So I had a client that had a big loss, with the wash sale adjustments, and he's thinking he's doing great and not going to have to pay as much in taxes, but he had to add all the wash sales back, and they show it as disallowed loss, and this is what really people think they're losing this, and that's what creates a lot of the confusion.
Well, no, it's not confusion. It's on purpose. It is on purpose. They try to make you think you lose a wash sale in perpetuity or you can never get it for a long time. They do that on purpose because they want you to buy and hold. They don't want you to actively manage and have risk management. So the reason Don is able to keep drawdowns to single digit when the market's down 20 or 15 is because he doesn't mind wash sales. He doesn't care. So he's making high gains with lower drawdowns in the market by about a third to 40%. So that's why you want wash sales. And Wall Street wants you because they want you to have the pie charts or us, target date, asset allocation, lifestyle funds, where they got some of all that stuff, and then they don't want you to trade it very much. Because then you'd have to do work like what we do. You actually have to manage it all day instead of just stick it in a mutual fund and farm it out to somebody and go play golf. But I'm telling you that is on with intent. They want you to think that wash sales are lost. I'll even ask the listener, listen, if you think that you lose a wash sale, if you've been led to believe by the Wall Street that you lose a wash sale and you never get it back, or you don't, then send me an email. Let's see how many emails we get. I guarantee you, I talk to a lot of people, Todd, and they think wash sales, you lose them. You never get them back. It's wrong.
And it's all in the way they're presented on the 1099.
Right.
It makes it look like you're losing it.
Right. And they do, but Schwab actually adds it back in, so your taxes are correct and they've adjusted for it. But when you see that wash sale, it looks like I'll have $100,000 in wash sales and I've used all of them but $500 of it. Okay.
Yep.
So I'm $500 difference, not $100,000. And it's the tax on that. So it would be the tax on $100,000 or 30, 35, whatever, and the tax on $500 or $200. So they want to make you think that you're out $20,000 or $25,000, not $200. That's the difference in your mind, and they do that on purpose. That is with intent. If you talk to any retail investor, they think you lose a wash sale. Anyway, that's a good point. I appreciate it, Todd, that he's right. Every brokerage firm does it slightly different. It makes it even more confusing. That's why you need a CPA that understands wash sales. We've got 2 or 3 that actually are clients of Revere's, and they're very good at accounting. So if you need a good CPA, let me know. They're also more reasonable than most. Anyway, all right, what do we got next, Don?
Connor's going to go through some recent trades, 2 winners and 2 losers. Take it away, Connor.
Yep. So, yeah, got 2 winners and 2 losers to present today, and we're going to start with Robinhood as the first winner. If you just bring up the daily chart on this one, Don. And when I look back and review some of the best trades, they always have a very simple thesis. And with Robinhood, was quite a simple thesis, easy to understand. This was showing relative strength versus the market during April. It reclaimed back above all key moving averages, had a huge weekly, monthly base, and then fundamentally, good earnings, good sales. And this was just Robinhood's kind of a paradigm shift for the new generation in investing. And that just had the big old N to this one with the new crypto card, allowing trading Bitcoin on their app, and just a lot of retail adoption in Robinhood. So the thesis was pretty simple. And if we get into the execution, May 1st was the first entry into this one. And this was actually when it was down on earnings. The first entry was at around $47 a share, and it had a good earnings report, and it pulled back to that cluster of moving averages. And we've mentioned this before, but there's so many different ways to skin the cat when playing earnings. You can buy the gap up, you can buy the undercut like CRDO. There's so many different ways. In Hood, this initial entry was a little unconventional, but the only thing that matters at the end of the day is your risk. And this gap down on earnings right into a cluster of moving averages. So that was the first ad. And then May 2nd followed on with another pyramid buy at $49 a share. So it moved up $2 from the entry, added again. And then the final ad, May 7th, that was that really clean technical setup that second arrow is pointing to, as it broke out through that flag. And that ad was at around $49, $50 a share. And that was the breakout to me. And then it started running up quite nicely. And so May 16th was the first trim, and that was at around $62 a share for about 31% gains. And the thought process here was that there was so much volatility in the market. It did have that capitulation bottom in the general indexes, but again, you just never know. There was a lot of uncertainty with tariffs, the news flow. So in this moment, we just wanted to, take a trim and manage the worst case scenario, and that way the trade was financed. And so this one has just been continue to run higher extremely well. And then 7-1 at $95. That was the second trim. That was about 102% gains, and basically here 3 ATR, gap up reversal against that 100 psychological level. Just getting more stretch from the 10-week and the 21-day moving average, and just a logical place to take some gains. And then fast forward to today. Today was another trim at $113 a share, and Protection did the same thing as TurboTaction, and this was 135% gains as well. And now, this is getting a little bit extended, but again, absolutely one of the strongest stocks in the market. And now this has been trimmed a handful of times, and now with the position size, feel comfortable holding this through a pullback. And if that does, potentially look to add back onto that. But for now, the rest of the position is just going to be trailed with the 21-day moving average, as it has not broken that average the whole run. And go to the weekly, I believe this is still 35-40% above the 10-week moving average. So if that starts to get back up closer, then would trail some with the 10-week as well. But for now, that's just too far down. Yeah,
This is a growth stock investor's dream. This is why we do the way we do. This is a 10-time return versus what the S&P did over the same period of time, and the way it rides the 8-day exponential moving average higher. We talk about that all the time. A couple of undercuts. That doesn't mean that's why you don't set your stop right below the moving average. You give it a little bit of room. Give it to the end of the day, maybe in a bullish market, but. Yeah, we both portfolios benefited greatly from this one. Nice, Connor. Next up.
Yep. Yeah, so that was HUD. Next one is LEU, Centrus Energy, and continue. And how I mentioned HUD is that I find the best trade just have a super simple thesis, and LEU is the leader in uranium enrichment. It's actually the only pure play in the market right now. The group was extremely strong, and the need to power all these data centers just made a lot of sense. And so this one we're still long right now, and 523 if you show that day on the chart, Don. So this day was LEU gapped up on huge volume, and this day was President Trump signed a series of executive orders designed to significantly boost the U.S. nuclear energy industry. So when I saw that news, I got even more bullish. It gapped up on huge volume. It was breaking out of a huge base. I like the story. So ideally, I would have bought that day, just wasn't prepared for it. So the thought process there was wait for a flag, wait for an entry to get in, and that came on 6-3. Took a position in this one as it was starting to break out of the base after, couple day consolidation. Wasn't much, but in a strong market, things don't really rest too much. And you've seen HUD, any pullback into the short-term moving averages could have been a buy and you would have made money. So that was the first entry at $137 a share. And that was coming out of that big base, like the story, had that catalyst with volume. So to me, this checked all the boxes for a high probability trade. And then on 6/11, trimmed some into strength at $162. And that was just for a 20% gain to lock some in to finance the position to hold for the bigger move. And then it continued to go higher. And on 6/20, you can see it started to go a little bit parabolic. And we sold some more at $207 a share for a 50% gain on that piece. And then you can see after that, it started pulling back. And reviewing this trade, I should have added back what I sold off the 21-day moving average, because as you can see, pulled back to the 21-day, formed a 6-day tight range, and it's just exploded out of that setup. And that was super clean. The first pullback to the 21-day moving average after a big move up, big base breakout, is typically a buy, along with, if you're looking at weekly charts, the 10-week moving average. So that should have added there, but did not. And for now, still trailing this position. Right now, it's up 80%. It's having another really strong day today, and it reports earnings in August. So if it continues moving higher, potentially look to take some more off into earnings and then see what earnings has in store. The cushion is quite big now, so don't have to worry about not being able to hold into earnings with the cushion currently. So this one's been really nice, and getting a lot of volume and trading up the right side nicely here. So that is two winners, and now on to the losers. RKLB, this is the first one, and this one's kind of painful. So the thesis here is May 27th. About a starter position in Rocket Lab at $27 a share. And what started to happen was this, look left on the chart, you can see this had a huge run in 2024 and then pulled back with the general market. This is a high beta name, so this correcting 30-40% isn't out of the ordinary. And you can see it went sideways on the 200-day moving average and started hooking back up. And then that gap there, this was when Trump and Elon Musk were having some issues all over social media, and they were arguing. And the initial knee-jerk reaction was this was going to be beneficial for Rocket Lab, and just due to SpaceX and Trump and Elon going at it. And so it kind of gapped up around here, and then it started to pull back in totally normal action to me, and then added again on April 5th as it started to U-turn back up. And at this moment, it had like 2 days up through that 30 level, and we were sitting, up double digits percent. And then this came all the way back down to broke the 21-day, was 2 closes below the 21-day moving average, and was living below, and just showing no relative strength. A nice win back to break even, and got stopped at $25 for a 4.5% loss. And that quickly marked the lows, and since then it's up around 115%. But I wanted to show this because this happens. It's part of the game. You just never know. It was below the 21-day. It didn't seem to have any momentum from that catalyst, and just took the small loss, and then it shot right back up. And the lesson here is don't be afraid to rebuy something as it shot back up, back above key moving averages with nice volume and range. Could have been bought back. And like we just talked, like the wash sales doesn't really matter. If I would have bought it back, it would be, up quite a bit. So that was Rocket Lab. And then another loser, Reddit. This one just plain old didn't really work. Bought this June 30th at $150 a share, and then added again on July 1st at $154 a share, and started to come back up. And then it just pulled back into the 21-day. Wasn't really finding buyers off that average. And in this market, a week or 2 weeks of no progress in a position, better to rotate that capital elsewhere. And that's what we did with Reddit. Got stopped on July 16th for a 5% loss, and see, it still looks all right, but just wasn't showing any traction or progress since the buy. And especially with a lot of names running and a lot of big themes right now, this is just kind of being a laggard right now. So that's 4 trade reviews from since April.
Absolute transparency here at Revere. We talk about our winners, we talk about our losers, and not only on this podcast, but every night on the videos as well. Sometimes they just don't work. I ran into the same situation with Uber this week. The market's going higher. It's showing zero relative strength. Got stopped out on it earlier this week. Great stuff, Connor. Dan, that's it from the technical analysis side. You can take us on home.
Folks, listen, so you saw some examples there, and you saw some examples that Connor did and the team did, where they had some stocks that worked out and broke out and went much higher, and they did great. But then they had a couple, like those last two, that didn't, that kind of went sideways or flat. And so those couple that they bought that went sideways or flat, they keep the losses to single digit. They keep them small. And then they let the winners run. And I know that's easier said than done. I know that sounds, keep losses small, let the winners run. I know you heard that. But that's what you have to do if you want to have risk management. And there's only a handful of stocks at any given time, 10, 15, 20, that are the best of the best. And so sometimes they'll go up and down, and you got to manage that risk. So you're going to have wash sales with those best stocks to be able to manage risk. But they'll offset when you buy that same stock back and then sell it again. You don't lose the loss. But Don and the flagship Grotection portfolios annualized long-term 12, 13% with no bear markets ever. We're going down a third to 40% as much, way less than half, as much as the S&P. That's an easier way to invest, and you do it through hard work and through all this active trading. So anyway, that's one way to do it, and we think it's a much better way. And Don and I have all of our, we've got some, real estate and physical, hard assets, but all of our paper assets are in these exact same strategies with our clients at the exact same timestamp and price. So if you want your money, which is the name of this podcast, just to look like our money, come join the Revere family, and your performance will track just like Don and mine. Of course, we're gross and you're net because you got to pay us a fee, and I don't charge ourselves a fee. But other than that, it will be exactly the same, down to the positions and the performance. One thing I didn't get to in the mailbag, there was an article about Stifel getting a lawsuit charging excessive 401k fees. Folks, it's not about Stifel. I don't really care. It's about the biggest part of your money to be in 401ks, so that you don't want to turn your 401k into a 201k or worse, a 101k. You need to have that analyzed. You need to look at the blackouts, the short-term redemption fees, the limited choices, and manage it the best way you can. You might be able to self-direct, though, and have a self-directed option where you could do individual stocks or ETFs and trade in real time and not get the end of the day closing price with their pre-selected 12 mediocre, lousy mutual funds. There's a better way to invest. And at Revere, we're completely transparent. We're the most transparent advisor, not only in the United States, but the world that I'm aware of. These guys are doing a video, a short market video Every night the market is open, telling you what we're doing. Then they're doing stuff on the weekends. We put out more content than any advisor I'm aware of. And if you just go to revereasset.com, up in the right-hand corner, there's a subscribe button. You can subscribe to that, and we'll send out our video newsletter every night the market's open, plus this podcast. This podcast will come into your inbox Saturday morning. However, we're recording this at 10:30 Central Time, and it'll be done about 11:30 Central Time. Zach will have this on the YouTube channel. Just go to Revere Asset and hit subscribe. You'll have this a couple hours before the market closes. That's what our stock nerds to do. Next to that subscribe button, there's a contact us. You can send me a question or a topic you want talked about, a stock, or you can ask for a complimentary portfolio review. And you can always call us old school at 855-REAL-WEALTH, because it's your money, not their money on Wall Street. Your money.
And it's not how much you make in the markets, it's about how much you can keep.